You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the other earnings news, Emily, was Boeing. They put out some good numbers for their quarter, but they pulled their guidance because there's a lot of questions as to what the regulators are going to ask them to do about some of their aircraft and some of their delivery capabilities and things like that. Pulling guidance is, to me, a big deal.
Right.
Yet the stock's up 3%. So
it seems like it's working for the investors. They say, we're going to pull the guidance. We're going to focus on safety. And that was enough to bring the stock up 3%.
All right. So let's bring in somebody who actually does this stuff for a living. George Ferguson. He's a senior aerospace, defense, and airlines analyst for Bloomberg Intelligence. He's been following Boeing for decades. He knows what he's talking about here. George, first, give us your takeaway from the quarter. And then second, I guess more importantly, is what's behind their decision to pull their guidance, do you think?
Yeah, so thanks for having me on, as usual. So I thought the quarter's numbers looked, pretty much in line with what we expected, maybe a little bit better commercial airplane. Some of the cash flow generation was a little bit better, a lot of it from deposits, that they're getting from airplanes as they move through production. So I wouldn't call that sort of, that's good cash flow, but I wouldn't call it super high quality, right? Like when you're generating a lot of cash from your core operations. Their global services business had some very nice margins, even better than we expected. And that's been a star performer. It's good to see that holding up. But yeah, I think the real story here is about going forward, how they nip these quality problems in the bud. And so I do think that as I think about it more, sort of pulling back guidance, I think that indicates that management is ready to do whatever it takes to get these quality problems in hand. And so, my sense is maybe they think, look, we may not want to be beholden to an exact number of airplanes in 2024 as we dig through our manufacturing process and through the supply chain processes and make sure that we're getting a quality airplane out the door every single time. So if pulling guidance is all about that and the efforts around that and what it's going to take, and focusing again on quality over just management metrics, I think that could be a very, very good sign. The management team is crystal focused on this is what we have to do.
How different is that than, sorry, go ahead.
No, go ahead, sorry. No.
Well, I was going to say, how different is that than what the company has already been doing for the last few years? Were they not as focused on quality and safety beforehand? Like, how much of this is truly a turnaround and a change for Boeing?
So I think the business has just materially changed. I was at an aerospace defense conference last week. I didn't need the conference to tell me this, but I was surprised that it was persistent. And what I heard from people at the conference over and over again is that finding employees and employee turnover is still a problem in this industry. It's still a problem. Now, I think that the higher you up in the tiers, like a Boeing or an RTX or a GE, it's easier to retain employees because you provide great benefit packages. Everybody wants to be there, but even they have had a lot of turnover. And so I think pre-pandemic, you could potentially fall back on the thought in the manufacturing process of Boeing that you had very, very seasoned folks on the line that have been well-trained, seen years in and years out of the business, and we're always going to get it done right. But I think with the amount of turnover they've had, they really need to go back and rethink, how they supervise the line, how they train the employees, and they have to create more stability by investing in those people. And so I think this business has materially changed since the pandemic. I will also say that Boeing has been sort of pushing this outsourcing of the business. Again, they were doing this pre-pandemic, and this is all about, they want to sort of turn it into the auto industry where you outsource the subcomponents, you bring it together in Renton, and you put together an airplane. And that's turned the supply chain into a much bigger, portion of what you're doing. and it's global as well, right? You're making some of these doors in Malaysia. Things are coming from all over the world into Renton to turn into an airplane. And I think that's making it more difficult to keep track of the supply chain and the quality in the supply chain and what folks are doing down at those factories. And so I think it's materially changed, and that's the problem.
So, George, and that sounds like a problem to me that was probably decades in the making, i.e., going more to subcontractors and as part of globalization, perhaps. Is there a sense that this is really a long-term fix, that investors should not expect anything months, maybe it's going to take years here?
Well, so I mean, I don't think they're going to stop production. I do think they're going to dig through the supply chain, sort of hopefully methodically and figure out where there could be sources of problem. But I think what it means is that you're just not going to see potentially the margin and the cash flow out of this business that you saw pre-pandemic for years, while they spend more money and more time and invest in people and go down and make sure that everything works. Some stuff may need to be reconsolidated back at sub-tier suppliers or even at Boeing if they can't get comfortable that they're going to get the quality out of it. I think it drags, like I said, an earnings cash generation for
George,
years from now.
At the same time, what I hear from you and from others in the airline business is there's a big demand for new aircraft out there. So how do they balance maybe slowing down the line a little bit with the fact that their customers need more and more of their product?
So I think it hurts. I think you'd like to be breaking to higher build rates now. Airbus will get market share. But I think in the long term, if you don't fix the quality problem here, you'll lose long-term share and competitiveness, and that would be really, really bad.
What does this mean for Boeing's stock price? Because like we said, it's up today, but you compare it to Airbus, it's underperforming on a year basis by 33 percentage points, Boeing versus Airbus. So is this enough to bring investors new money into Boeing? Or is Airbus still going to be the outperformer here?
So I mean, I think, Boeing investors are going to have to take the long view here, right? Because again, I don't see any quick fix, quick leaping to much higher build rates, much better cash generation, because I think they need to invest back in their business. Airbus doesn't apparently have this problem. I think more of the supply chain is still in-house at Airbus, or at least better controlled. And so I think you're going to see that Airbus is going to perform fundamentally better here.
Is there a regulatory risk here for Boeing? Is there any sense that, I don't know, Washington, I'm not sure which agency would say, hey, we're going to be kind of paying a lot more attention to you guys, forcing you to slow your line down, anything like that?
I definitely, right. The FAA has already said they're going to increase their oversight of Boeing and the suppliers. Look, in a perfect world, you wouldn't want to have these quality problems, and you'd like to be filling out less paperwork. You could make your business more efficient. They're just not going to get that here. We could all understand the FAA's reputation's been hurt as well. So they are going to have more regulatory oversight, and that will be a drag.
All right, George, thanks so much for joining us. We appreciate that as always. George Ferguson, he covers the aerospace companies, the defense companies, the airlines companies, that whole ecosystem. That's where George's investment research focus is. And so he's our go-to person on Boeing, the other aerospace companies, and then the ultimate customers, the airlines. And then, what we hear from the airlines is traffic's back. We need new planes. We need more planes. We need more efficient planes. And that's good news for the the Boeings of the world and the Airbuses of the world. But as George was suggesting, probably top of order for Boeing is to kind of get their quality issues addressed, as quickly as possible, because that's in the long-term health of the company.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
New York Community Bank, surprise loss here. Cut the dividend, stock's down 35%. Let's break it down with Herman Chan. Herman Chan follows the regional banks for Bloomberg Intelligence. He joins us live here in our studio, here in our New York City headquarters. Herman, what happened at New York Community Bank?
New York Community. So if we go back to what happened in March and April of last year, They were the bank that bought the assets and deposits from Signature Bank. So they became a much larger institution, cleared that $100 billion threshold, which is like a step up in regulations. Now, it seems like they're a bit cautious with that step up in regulations and the upcoming stress test. So they're cutting the dividend, reducing loans, trying to shore up their liquidity and capital. And then on top of everything else that I just talked about, that they posted some weaker asset quality. So there's questions on if they're going to see more loan losses in apartment lending and office lending in 2024.
What do we know so far about why they're so uncertain about this credit quality outlook?
Yeah, so New York Community is largely an apartment lender in the New York City area, rent-controlled, rent-stabilized apartments. So those buildings are affected by recent New York rent rules that cap how much you can charge to your tenants. On top of that, you have higher interest rates, so it squeezes the landlords, and there's a lot of refinancing risk ahead. So they posted a big loss there in the fourth quarter, and there's questions ahead. They have about 4% of their loans in office exposure, so that's a touch higher than the median in our coverage universe. So there are some credit quality concerns ahead, and they built their reserves pretty much in line with peers in the fourth quarter to address that.
I'm looking at the Spider S&P Regional Banking ETF. KRE is the ticker. It's off 3.45% today on this news, presumably. How much is this a New York Community Bank problem versus maybe a wider regional bank problem?
Yeah, so New York Community is really the last of the larger regional banks to report their fourth quarter earnings. And pretty much across the board of their larger peers, everybody was actually pretty sanguine about 2024 credit quality. So this seems more of a New York Community specific issue of needing to shore up their balance sheet and facing a blip on their credit quality that they need to instill some more confidence in the market ahead.
Do you think someone's going to ask a question to Powell about this today? Or do the reporters already have their questions planned out?
No, that would be a good one because it's certainly topical.
Yeah, I mean, what would the Fed, how would you expect Jerome Powell to react to a question on, like, does this signal more weakness?
Yeah, I'd assume he would say something to the effect that the banking industry is resilient and you've seen stability in deposits and strong credit quality for the industry. New York Community specifically had an issue with the fourth quarter, but I would say overall, the banking sector has been really strong and resilient ever since that March and April turmoil, and stabilized deposits, increased their capital. The larger ones are shoring up capital and liquidity ahead of tougher rules, so it makes for a much sound and safer system.
So where are we? Like, how would you characterize the industry in terms of getting to where it needs to be in terms of their balance sheets, their credit quality? Because it was such a shock, I guess, a year ago when we had some of those regional banks kind of hit.
Yeah. So ever since that March and April timeframe, a lot of the banks have been defensive in nature. They've pulled back on lending. They've exited some loan portfolios, exited relationships that weren't profitable. Just been very conservative with how they lend and how they operate. So they've had 3 quarters of conservatism that they've built up their reserves. So they've done a very good job of addressing some of these issues. And aside from what's happening today with New York Community, I think the market's been pretty receptive to the actions that the bank management teams have done over the course of the past 3 quarters.
And where are we just in terms of, kind of repairing the earnings capability of these banks? Because that's kind of what you told us all along, that this was going to be more of a challenge from the earnings power of these regional banks as they deal with higher rates and so on and so forth.
So we're getting towards sort of the end of the weakness in the top line. The the pause in rate hikes last year has helped shore up the pace of deposit repricing. So the margins, the net interest margins for the banks are starting to stabilize a bit, and we're hoping that once rate cuts start materializing, the industry in the back half of the year expecting a resurgence in lending and improving top line performance and improving earnings. But really all of this is predicated on if we get the rate cuts and if we get a soft landing.
How are investors supposed to be thinking about the dividend cut for New York Community Bank, slashing the payout to shareholders to 5 cents from an expected 17 cents? Yes,
so that's an interesting thing because New York Community has historically prided themselves on having a strong dividend, had a lot of insider ownership of the bank, and so the dividend was very key to them and to their shareholders. They do skew a little bit historically to a retail investor base as well. So this was a decision that the CEO said they didn't take lightly, and it was more of another step to build capital ahead of the tougher regulations. They're pointing to a CET1 ratio of 10% versus the current 9.2%. So earnings generation and the slashing of the dividend could help them get there by the end of next year.
So I'm looking again at that Spider S&P regional bank ETF, up 33% from, I guess, the recent lows, I guess, back in October. Is that, but that they haven't retraced at all. I mean, when you talk to investors, do they still think, hey, with a Fed that's likely to cut rates in 2024, there's still room to go with some of these names?
Yeah, it does. There's stocks have rebounded about 30%, as you mentioned before. There's some upside if we get that loan growth in the back half of the year. So that's what the management team seemed to be pretty optimistic about. They talked about building, loan pipelines, and so that all of these anecdotes seem to be positive that lending, which is pretty much flat over the past couple of quarters, can really start picking up again once interest rates get lower. So that's the upside. The downside is, do we get a downturn in credit quality, and do rates sort of stay higher for longer? So that's where we are today with the push-pull of the bull and bear markets.
And what are the banks, what are the management teams, what have they been saying about their expectation for credit quality over the next 12 to 18 months? Are they taking higher reserves, or have they already done that?
They are taking reserves, but it's been pretty measured. So loan losses they continue to normalize. So they've been pretty low ever since the pandemic period, with all the stimulus that was sloshing around the economy. And now they're pretty much back to pre-pandemic levels, which were still low by historical standards. So they've been taking this time to build up their reserves a little bit more due to some of the issues that are facing the industry, like concerns about office commercial real estate and leveraged lending and apartment lending. So those are sort of like the hot button places.
But we haven't seen, or I guess let me ask it this way: have we seen a regional bank cut their, I guess, office, write down their office portfolio? Have you seen that yet?
We've seen reserves increase. So there's a wide range in the reserve level. So the most conservative are banks like U.S. Bancorp and Citizens that have a 10% reserve. And then on the other end of the spectrum, there's some that have only like a 4% reserve. So there's a lot of questions of how this all will shake out over the next few years.
I don't know. I think this commercial real estate, particularly the office thing, when we start seeing trades happen, like just a random office building in Midtown 3rd Avenue trade, I don't know what the haircut.
Street, it's still vacant.
It's still vacant. I know. I mean, I don't know what these haircuts are going to be. And again, Barry Stern, who knows from real estate yesterday, he's saying he thinks that haircuts are going to be huge, like 50%. I don't know. We'll have to see. Now, I wonder how the banks react to that. Herman Chan, thank you so much for that. We appreciate it. Herman Chan, he covers the regional banks for Bloomberg Intelligence, so he's been extraordinarily helpful to us as we kind of deal with some of these regional banks and some of the challenges that they are facing.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
The markets are certainly pricing in a dovish 2024 in terms of rates? Let's check in with somebody who actually gets paid to do this stuff. Glen Smith, Chief Investment Officer, GDS Wealth Management, Flower Mound, Texas. Glen Smith, thanks for joining us here. Where's Flower Mound, Texas?
Absolutely. We're about 10 miles north of Dallas.
Nice. See, just say Greater Dallas. I mean, Flower Mound is nice.
Are there flowers on the mound?
There actually is a flower mound. It's very
perfect.
small. I think it's about 7 acres, but there's definitely a flower mound.
Awesome. Check it out next time down. All right, Glenn, what are we doing here with this Fed? We're going to hear from them later this afternoon. The market certainly says, hey, 2024 is going to be a year of rate cuts. How are you guys kind of pricing that in?
Absolutely. We think that the Fed is going to talk about how resilient and strong the economy is. Consumers are doing really good. We have inflation dropping, not quite at their target of 2%, but we're at 2.9. We have unemployment numbers very, very low, and I think they can be a little bit patient here. I don't think they want to lower rates before they actually need to. In the 70s, obviously, we had Arthur Burns do that, and then what happened is inflation was persistent, and I think they want to do this right the first time, and because of that, we think rate cuts won't start until June of this year, and we will have 3 rate cuts every other Fed meeting in 2024.
Glenn, how are you thinking about the market reaction to the Fed today? Because like John was saying a little bit earlier, we already have the 2-year down 11 basis points today. So what do we need to move yields even lower? And if Powell isn't ultra dovish, does that mean that we actually see yields reverse higher today?
No, I don't think so. I think the economy is very strong, and that's what's giving them a little bit of a mulligan here for rates not to go up. We think that that they have a little bit of margin for error because the economy is so strong right now. I don't anticipate rates changing until later in the year when inflation comes down a bit.
All right, so Glenn, what do we do here? I mean, Emily Graffeo, she's long those Magnificent Seven stocks. She's been laughing all the way to the bank. Other folks like Matt Winkler and me, we are not so smart, so we weren't long those stocks. What do we do here in 2024 if we've missed some of those big tech names?
I think the Magnificent Seven, if you own them and you're not overweighted them, you want to maintain them. But I don't think this is a great entry point. I think there's other sectors out there, whether it's financials, whether it's energy stocks. Specifically in financials, we really like JP Morgan right now. If rates do stay elevated, we have net interest margins that will be phenomenal for them and continue to give them earnings. And if rates are cut in June like we anticipate, the mortgage activity should pick up. JP Morgan had a bit of a downer in terms of investment banking the last couple of years, and we think that's going to turn around from in 2024.
What about
on the energy? Go ahead. Sorry.
I was going to ask about multi-asset portfolios because you're chief investment officer. So how are you balancing stocks and bonds and 60-40 this year? If it's not all big tech, how are you thinking about the whole portfolio construction for 2024?
Sure. In terms of duration, what we've been doing for starting around 2022, we shortened the duration in shorter term treasuries and bonds, treasuries and corporates. Just lately, in the last 60 days, we've been increasing the duration in anticipation of interest rates dropping from different ETFs that are money market like bonds into longer term durations. In terms of the overall portfolio, we think it's important to look at different sectors other than just the Magnificent Seven. You want to be diversified in different parts of the economy.
Well, you're down there in Dallas, Fort Worth. You have to have a call on energy. What's your call on energy here?
Absolutely. We love Diamondback Energy. Diamondback Energy is a Permian Basin developer. They have over 476,000 acres, 8,000 drilling locations. What makes them unique is that their price of profitability per barrel is only $50 a barrel, unlike many of its competitors. We think the valuations are much more attractive than even an Exxon Mobil. The cash flow has been amazing. They have lower operating expenses than its peers. They've consistently paid a dividend, and we think that will continue for foreseeable future.
All right, well, I'm just looking at the map here. You guys are right next to the Texas Motor Speedway, which I helped finance back in the day. That is a monster speedway. You laugh, but we just raised a ton of equity, a ton of debt. We built Texas Motor Speedway, Las Vegas Motor Speedway.
What deal were you not involved in?
We were active back in the day. Now, can you water ski on Grapeview Lake?
Grapevine Lake, absolutely. Not only Grapevine Lake, but Louisville Lake. Those are two
nice,
massive lakes. I'm originally from Northern California, so this was different. There are different lakes in California, but we can.
Grapevine Lake, yeah, that looks cool. All right, very good. Appreciate it. Just getting a sense here what's happening on these markets. Glen Smith, Chief Investment Officer, GDS Wealth Management, Flower Mound, Texas. It's just north of Fort Worth. Fort Worth is one of my favorite towns. Like, I'll stay in Fort Worth as opposed to Dallas and drive to meetings in Dallas.
Never heard anyone say that.
What does it have that Dallas does
It's
not?
a real cowboy town. Like, Dallas is chic, you know. You're in Fort Worth. You feel like you're in Texas. Cowboys and stuff like that. I love Fort Worth. It's a great town.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
When I went to L.A., when I was on the SI side, Emily, as a sell-side equity analyst, my salesman would say you have to come to L.A. at least twice, preferably 3 times a year. And when you go there, you see Capital Group and you see TCW. If you don't get those 2 meetings, don't even go, because those are the lockdown meetings you get. Now, when I went to TCW and in these fancy offices in downtown L.A., which I can still see here on the Zoom call with Mr. Purdy, I avoided the fixed income floor desperately and just went right to the equity floor because they're much more fun there. Steve Purdy joins us. He's co-head of global credit at TCW. Fixed income, you guys do math. I don't like math, Steve, so that's why I stayed with your colleagues on the equity floor. I got to get the house call here for TCW. What are you guys doing in the fixed income market this year? There are actually some positive returns in 2023 for you guys.
Yeah, there are. And first of all, thanks so much for having me. Really appreciate it. And glad that you've been to our offices, and we'll welcome you guys in January anytime.
Yes.
Let's start. The big picture for us is we think that inflation has peaked, which means that the rate cycle has peaked. And you got to give the Fed a lot of credit for what they've done. Now the question is, from here, how quickly will they be reducing rates, and by how much quantum? And we think today is a bit of a non-event. But we do think overall the economy is slowing, and that's the real story. We think the Fed's got to get ahead of it, but we're seeing a lot of breadcrumbs in what we're hearing from companies that the slowing economy might be getting a little bit away from the Fed, and they need to be very aware of that.
So we've been asking everyone today, what do you think Powell is going to actually talk about in his presser? Is there anything that he could say that could move the markets today?
Yeah, I think everyone agrees, and we're with consensus that nothing is actually going to happen from a rate move perspective. But it's really going to be about his outlook and how hawkish that feels. And we think they'll probably remove some of the language to give themselves runway to begin the rate decline. But we don't think today is a big day. What's interesting is to watch is how quickly the economy is slowing. And the results from this quarter thus far have been overall pretty positive. But we do think we're seeing some signs of deceleration, and we hope that he speaks to that in his Q&A today.
Hey, Steve, you guys are talking about a slowing economy out there. I'd love to get that kind of surprises. I guess given that background, I was kind of surprised in 2023 to see high yield was the best performing fixed income sector out there. How do you guys think about high yield versus investment grade in 2024?
Yeah, it was a barn burner of a year in high yield last year. And I think, one, people were probably expecting the economy to slow in a more dramatic fashion than it actually did. That's one. The second thing is the CCC cohort, and there's a couple of sectors in there, really cruise lines being the most dramatic, which came into the year at very low prices. And as we had this kind of remediation and the peaking of rates, people stepping back into the asset class really drove outperformance there. We're now sitting at about 320 basis points over the Treasury. That's within the top quartile of tightness over the last 10 years. So our perspective is that credit spreads on the high yield side, and even more dramatically on the IG side, are going to have to widen throughout the course of the year. So we think you're supposed to be a little bit underweight high yield and wait for a better time to enter that asset class.
What about the fact that we might see a lot of debt maturing in 2024 and 2025 and 26? I talked to a number of fund managers who say this is really a cause for concern. These companies that locked in low rates now all of a sudden have to adjust to a much higher level of interest, and that's going to cause some kind of economic trouble that's going to then trickle down to the rest of the economy. How are you thinking about debt refinancing specifically for these IG corporates?
Well, I'll pivot back to what you guys were talking about, home ownership. I'm sorry that you don't own a home, because those who do have 30-year mortgages have locked in a very low rate for a very long period of time. And that is the luxurious position that investment grade companies find themselves in. The average tenor is kind of 10 years plus. And so they've got a lot of time to wait and adjust to this new rate environment. High yield companies on average have about 3 years until they have to kind of climb that maturity wall that you are mentioning. And it is a challenge for certain of them. In the leveraged loan market, they have to reprice their balance sheet every month or 3 months. And we're seeing a lot more distress there, as managers simply weren't prepared to pay an additional 200 or 300 basis points just to operate their business. And let's remember that when your cost of capital goes up, that doesn't impact your business at all. That's not marketing. That's not a new property that you're spending for. That's not new employees. It's just the same business that costs you more to run every day. And that's going to be a challenge. We think people are taking advantage of this new issue boom in January while the markets are open to rush in and try to kick out those maturities. But it's really a show me story by each individual credit over the next few years as they try to digest how to pay more money and how they're going to manage their businesses given that additional burden.
Hey, Steve, how do you feel about credit quality out there? If your house call is for a recession, I'm guessing you're asking your analysts to kind of sharpen their pencils and take a look at the ratios and so on and so forth. How do you feel about credit quality out there?
You know, the management teams thus far have done a really excellent job. During the pandemic, we saw balance sheets actually get into a much better place. Personal balance sheets, as an aside, people paid down credit cards. They weren't going out as much. Corporates didn't go on big M&A booms. Instead, they tried to say it's a cautious environment. I want to bring down my leverage because we don't know what the world's going to look like. So it all feels pretty good. So when you think of near-term defaults or a spike in default rates, we don't see that happening in the near term. But what we do see is credit spreads right now are kind of pricing perfection. And we don't think that's a reasonable case given what we're seeing. And so the other thing we're hearing from management teams, as our analysts, as you said, are kind of plugging into their models every day, is the numbers are fine, but the outlook feels a little bit more concerning. And now we're starting to see job losses roll through. I mean, every day we come into our Bloomberg screens and see a blinking red number across the top. Yesterday was UPS with 12,000 employees. That is a good signal that companies are not as bullish about the future as what they are now. And we think that's problematic.
So, you guys, just about a year ago, you guys being the folks in California, were kind of at ground zero in some of these regional bank challenges here. And we just got another reminder today with New York Community Bank. How do you guys think about the banking sector, the financials here today?
Yeah, it's kind of an old story that's come back to light this morning. First of all, so are there lingering effects of the regional bank crisis? First, let's talk about the good news. The Fed reacted quickly, and what they did with Signature Bank and SVB, really, they deserve to be commended for that because it put a floor quickly under deposit flight, which was critical. Now, it also showed us, by the way, that the large banks, the globally systemic banks, are the safest place you could possibly be. And we continue to believe that as an investment thesis. Shifting back to the regional banks, the real crux of the matter here is commercial real estate. And it's very difficult as an outside investor to get really granular views, asset by asset, on what type of commercial real estate portfolios they have. And I think when Community Bank bought the Signature Bank portfolio, they had to get their arms around that exposure. We've learned today there might be more problems in that commercial real estate, and particularly the office sector portfolio than they had envisioned when they purchased those assets. So we think this is not a brand new story. It's simply this delayed rolling impact of the commercial real estate issue flowing through the regional banks.
Yeah, we had Barry Sternlicht, Chairman and CEO of Starwood Capital, on Bloomberg Television yesterday. He was talking about, he thinks the nut might be, $1 trillion of risk, their value add risk in the commercial real estate, particularly the office space. And so that is a big issue. And if that's the case, then that's going to have some pain for a lot of folks. Steve, thanks so much for joining us here. Really appreciate getting your time. Steve Purdy is co-head of global credit at TCW. Some real smart folks out there at TCW, both on the equity and fixed income side. And again, kind of the base case for TCW on the fixed income folks, the credit guys, they think a recession's coming. So they're kind of positioning their portfolio accordingly, kind of underweight high yield a little bit more on the investment grade and focusing on the balance sheet. So that is certainly a take there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Fed Day today. This afternoon, we'll have full coverage of that. People aren't expecting a whole lot here, but maybe a little body language about maybe when they'll think about cutting rates. Let's check in with a pro here. Kristina Hooper. She's a chief global markets strategist at a little firm called Invesco. Kristina, I guess the consensus is don't look for really anything today, but is it too much to ask for maybe a little body language on what the Fed's thinking about future rate cuts? What are you looking for?
Well, we might get a little more than body language. I think Chair Powell tends to be fairly candid in the Q&A session, even if he doesn't necessarily want to be. It tends to come out. However, I do believe there is a very distinct goal of the Fed right now, which is to keep a lid on easing financial conditions. And so I think he will try to err on the side of hawkishness, but I do think we'll get some glimmers of hope during the Q&A.
What do you make of some of the more recent data that we've seen? You look at employment cost index increasing at a slower pace than expected, ADP. These were both today coming in a little bit lower than expected. How is Powell going to be thinking about these signs that the labor market is softening?
I think they will matter to the Fed because it tells the Fed, this mosaic of data we've seen, is that we are still very much on the D train. And by the D train, I mean the disinflation train. In particular, the employment cost index is a very, I think, has historically been a rather accurate gauge. And it's one the Fed relies on to get a sense of total compensation. So that's important. We know that the Fed does react to the data. I go back to June of 2022 when they had messaged before the meeting that they would only hike 50 basis points, but then they hiked 75 basis points. And Chair Powell pointed to two data points, CPI and Michigan consumer inflation expectations, as pushing them to do 75 instead. So clearly data matters, and these data points continue to tell that same story.
One of the many reasons we like speaking to Kristina Hooper is that she, like me, is a fan of Cracker Barrel. How about that? You got to be right up there in front. I saw that in one of your notes here, Kristina. So, Kristina, given that backdrop of the Fed's going to be cutting rates, we're not sure when, but we got a pretty good conviction that they're going to be cutting rates this year. What's your how are you allocating capital these days? What are you telling your portfolio managers? What are you hearing from your PMs? How are you guys trying to position yourselves?
Well, first, Paul, I should say that I don't think it matters whether the Fed starts cutting in March or at the April 30th, May 1st meeting. I do think we're going to see more cuts than the Fed has suggested there will be in its December dot plot. So that's sort of the background. What I would anticipate is that we do see an economic slowdown, what I'll call a bumpier landing in the first half of the year. You can't have the kind of aggressive tightening we've had without some economic damage, but not a recession. And I think it's going to be really brief, and that we'll have a reacceleration sometime in the back half of the year. Markets tend to discount what they anticipate to happen with the economy. So I think what we're likely going to see in coming months is a stock market that is discounting that back half recovery. So I do think we're going to see some broadening. I think we're going to see small caps performing better. We're going to see cyclicals performing better. And I do believe the US dollar will resume its weakening, which should be a positive for asset classes outside of the US.
Okay, so broadening out in the equity market. What about on the fixed income side? Where are you seeing the most risk reward if we do get this slowdown, but a brief economic slowdown?
I think investment grade credit is that sweet spot. Because we are going to see something of a slowdown, we'll want quality, and I think it will benefit from an environment in which we're likely to see rates come down over the course of the year. But there's a lot of opportunities in fixed income, I have to say.
Yeah, I said that kind of the same thing, same time last year, and then investment grade just ripped last year. High yield ripped last year. What do you think about high yield versus investment grade?
Well, high yield certainly is attractive, but I don't see it as attractive as IG right now. However, that could change. If we get a softer landing than I anticipate, and we see a stronger reacceleration in the back half of the year, that should be a real positive for high yield.
What do you make of the New York Community Bank news this morning? Maybe we could just get your initial reaction to like what this means for credit quality and the regional banking sector from here.
Well, I think we have to ask ourselves whenever we see a situation like this, is this contained or is this contagious? And as far as I know, based on what we've heard this far, it seems like it is very much a contained situation. Not that, I think far less significant than what we saw last spring. But of course, we're going to have to stay on top of this as the news unfolds and information unfolds. And of course, more earnings come out for other regional banks.
So, Kristina, on the equity side this year, we're just about to finish out a pretty solid January to the market after a really good 2023. What are the sectors that you guys are spending the most time on these days in terms of, opportunities?
Well, we continue to see opportunity in technology. I think technology as a long duration asset class is sensitive to long rates, and so it should benefit from an environment in which rates are falling. I also think tech is more defensive. It has become a more defensive asset class in recent years. So it's going to hold up, in my opinion, relatively well, despite some of the recent disappointments around earnings announcements. But where we're focused as well is the cyclicals. Those are areas of real opportunity, especially if we see a nice bounce back in the back half of this year. We're also seeing a significant amount of investment. Legislation like the CHIPS Act is having an impact in cyclical areas of the economy. So that is a real focus for us.
All right, very good. As always, Kristina Hooper, we always appreciate getting a few minutes of your time. Kristina Hooper is the Chief Global Markets Strategist at Invesco.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.